if we can buy a rental that's going to negatively cash flow $50 a month, we're still going to do it, because guess what? Next year, rental rates are going to go up. Our costs will generally stay the same, and we're locked in for rates, and we may be able to refinance. So we will cash flow negatively for a short period of time to get that $200,000 over that 10 years.
Those guys are idiots. That's the bottom line. I mean, first of all, who wants to write a check every month? And he made two really bad statements. The first one was, rents are going to go up and costs are going to stay the same. So I don't know anybody who's bought any real estate where rents go up every single year and costs stay the same. Both, number one, expenses always go up. And two, rents do not always go up. I'm not sure what these guys' angle is, but essentially, if you want to write a check every month and hope that rents go up and hope that expenses stay the same, do whatever they say.
So let's just do depreciation on that house. Like depreciation, say that house is cost basis $200,000 ballpark. We would get to write off over $7,000 a year in income with that one house. So $50 a month, who freaking cares?
And then they're just throwing the depreciation thing in there just to make it sound even better. The purpose of depreciation is to write off cash flow. And in this particular situation, there is no cash flow. So I don't know why you would buy a negative cash flow property and then try to market it by saying there's also depreciation. It makes no sense. Why would I take my hard-earned money out of something that's actually making money, even if it's a small amount, 2, 3, 4% a year, let's say, and then stick it into something that's negative, hoping that rents will go up and hoping that expenses will stay the same. And then I just throw the confusing word depreciation at the end just to make it all sound like they know what they're talking about, which of course they don't.
If you could borrow $1 billion, 0% interest for 10 years, would you do it?
No.
It's not worth it.
I don't borrow money.
There we go.
I can't believe how close-minded Dave Ramsey is, first of all. If you borrowed $1 billion and just put it in a 1-month T-bill, you would make $50 million a year. Just that. $50 million a year. And he said no. That's all he has to do. It's free money for $50 million a year. He said no. Now, I don't know why anybody of the right mind would do that, especially with inflation rate. The way it is right now, there's no way. If the reason we have the asset bubble the way we are is because of cheap money. So why he would ever say no makes no sense to me. The normal person doesn't have a big internet business that kicks off all kinds of cash.
My idea was you give every baby that's born in America a $7,000 account when they're born. They can't remove money from that account, and it's tax exempt, and it compounds, and it gets invested in like an index fund. By the time you're 65, it's $1 million. By the way, that would cost $20 billion a year to do that. Just take the number of babies times whatever, $7,000 or $8,000. It's like a nothing thing. It would start to give everyone in this country a piece of the success of the country. So I think we need these sort of savings accounts, and we can't wait until people start creating an IRA or 401k by the time they're, 25 or 30 or 35. You want to start when they're a baby, just because the laws of compounding. That extra 25 years is very, very material.
Well, that's what you need, Bill. You need $20 billion a year to manage. That's actually the whole point of this video, is to try to get more money into the wealth manager's hands. And of course, they quote these things like index funds and compounding and all that kind of stuff. And you hope that that can be the case, but it's not always the case. There's a cost to handing people money, number one. But really, the whole point of this video, the entire point of this video, is to have the government fund Main Street and then have Wall Street actually extract that money from babies. It sounds funny when I say it, so that they can manage it and make fees themselves. That's the entire point of this, and they're smarter than you are. So give the money to babies, let it grow, tax exempt apparently, and let me do it for you because I'm the one who could do that. And then at some point, you're going to have $1 million. The real question is, will that $7,000 compound enough to beat inflation? So what is that actually going to be worth? What's that $1 million going to be worth in 60 years? It sounds like a lot today. It might not be. It might not even buy you a car. And let's talk about what it would be if everyone was given $1 million when they were 60 years old, which is exactly what he's actually saying. That would drive prices up like crazy because everyone can get $1 million when they turn 60.
Here's how to invest in real estate like a pro. This is the beginner's guide to real estate investing in 9 steps. So first, you want to set up an LLC. You can go on a site like LegalZoom.com to do this. Then you're going to find a property listed for rent in a good area. Next, go pitch the landlord to let you sublease their property so you can launch it on Airbnb, and you can even throw in an extra $50 to $100 a month in rent. Go and order furniture from websites like Wayfair, Amazon, and Target and send it directly to the property. Fifth, hire a handyman to go and set up the furniture once it all arrives. Then Then you're going to hire a cleaner that specializes in short-term rentals to go and clean the property. Once you do this, hire a professional photographer. Please don't skip out on this. This is really important. Go and create an account on Airbnb, set up your property management and pricing software, and then finally launch it and start making money. I made $300,000 last year using this exact strategy. Check the link in bio or comments to register for my next free live event if you want to learn more.
Oh my gosh. So all I see, first of all, you don't need an LLC to buy real estate, number one. You can just buy it and then put it in there later. That's an expense. But everything else the guy's talking about is trying to make $2,500 per month. Just find somebody and sublease their place and make $2,500 per month. What a crock. It looks to me like the whole point of this video is to try to drive somebody to this free event, which, by the way, Airbnb right now is imploding right before your eyes because the supply has jumped, which has created lots of vacancy, and the pricing of Airbnb has seriously adjusted as much as 20 to 40% in a lot of markets. So the Airbnb wheels are coming off right now. So this is not a strategy you'd want to do anytime soon. Most of you guys know Danielle, my wife. She master leased a 3-bedroom garage to a guy that was doing this exact strategy. She did it because she gets a certain amount each and every month. Well, the guy did it, and he, of course, was going to do this exact strategy. And he hasn't cash flowed at all. In fact, he's severely negative from this exact strategy. And what he's doing right now is he's trying to move it to a long-term rental. As I tell you guys, the Airbnb strategy is not a bad strategy, but it should be plan C. It always needs to cash flow in the beginning. The first thing you do is you make sure the property cash flows. Then, and only then, if it makes sense to Airbnb it, and it may not, perhaps you can do an Airbnb. It doesn't always work like this guy is pointing out. I highly doubt this guy made $300,000 profit from this strategy. In fact, he probably spent $400 to make $300 would be my guess. You can't do all of those things, spend all of that money, and have these things run exactly to the $2,500. He's really just targeting everybody to go to his next live event.
There's no such thing as a negative cash flowing real estate deal, and here's why. See, many people will buy deals today, or at least put offers in deals, and they'll say,
well, I can't offer you this much because if I offered you this much, I'm not going to make any money every month.
And they're looking to knock it out of the park with every deal. The truth is that every deal can be positive cash flowing. The difference is that you must put more money down. Now, I'm not a big advocate for putting a lot of cash into a deal, but if that's the way you got to make the deal work, that's the way you got to make the deal work. If you're a great investor, you adapt to the changes in the environment. You see, you don't actually have a deal flow problem. You have a mindset problem. If you can change your mindset and say, hey, I need to invest in deals regardless if I have to put 10, 20, 30% down, that's okay, because in this environment, when the rate goes down, you automatically have built equity. Now, what you do is when the rates change, you go out and you refi cash out your money, and now you're positive no matter what, and you get all the money you put into that deal up front back. It's like doing a short-term loan to yourself and getting a very good interest rate on it, which is the cash flow that is going to come in return.
Okay, so there's so many things on this one. First of all, he does have a point. If you put more money down, like if you pay all cash, hopefully you cash flow. Obviously, you have to have somebody that's paying you in order to cash flow. The biggest issue here is the cost of the equity, the cost of the money that you're actually using to put down. So he used 10, 20, 30%. Well, if you can make that thing cash flow at 10, 20, 30%, that's awesome. But if you can't, I definitely don't agree that you just put more money down to make it cash flow. He is actually saying something that is true. If the more money you put down, the more it cash flows, but he doesn't consider the cost of the funds and where they're coming from. If it's sitting in a stock market, it's making you 5, 6, 7%, or it's sitting in a T-bill at 5.5%, or it's just sitting in a savings account, it's making money somewhere. So if you're just sticking it somewhere and then you're calculating the return, you got to make sure that it's not just apples to apples. The whole point of investing is to actually make money on your money, not to just move it laterally or even backwards. That's the entire point. You want to always be moving forward, and you want to always be trying to beat inflation. He made a comment about interest rates going down. Well, he's not going to be able to predict that. As we all know, rates just went up, and they're predicted to maybe go down a little bit, but so far that hasn't happened. It needs to cash flow today with a fixed rate interest rate. That's actually what it needs to do. And you need to make sure that you have somebody in there that's actually paying something that makes it cash flow. If that math doesn't work, leave your money in the stock market, in the bank, or in a T-bill, whatever it is, but don't move it just to move it. Don't buy real estate just to buy real estate, because the whole point of buying real estate is to cash flow, also get the capital gain, but also, of course, take advantage of the tax benefits.
I've owned over 2,000 pieces of real estate in my life. I've got several $100 million worth of real estate today. One thing I know for sure is if you tell me the renters are going to pay the payments for you, that tells me you've never managed rental property. That tells me you've never done it. That's 100%. You are a novice at best, an idiot at worst.
What Dave is arguing about here is just purely semantics. There's no question that if somebody's sitting in a seminar and they're handing him money and listening to him, that's cash flow. If somebody's sitting in one of his rentals and they're paying him through rent, that's cash flow. Now, yes, that cash flow pays the bills, but at the end of the day, without the consumer, without the rent, without the person that's coming to attend his seminars, he's got no business. What he's saying makes no sense. The dotted line is no renters, no income. No seminar attendees, no income. No business, no cash flow. That's it. So somebody has to be paying those bills for people. Somebody has to be generating that income for somebody to be able to pay that mortgage. So in a sense, he's correct, but really, at the end of the day, he's absolutely horribly wrong here.
My idea for making $1 million is just margin flipping. So you can margin flip anything. In fact, that's what people do when they flip houses. It's like, all right, I bought a house for $400,000. I can put some equity into it, or I can put some sweat into it, whatever it is, and that house could be worth $600,000. The cleanest margin flip in real estate is reassigning. You effectively find a property that is undervalued. Maybe it's at $800,000. You know someone will pay $1 million for that property. You can assign that and flip that margin. Find something for $9 million that's actually worth $10 million.
Yep.
Buy it for 9, sell it for 10. That's a quick way to make $1 million.
He just said, find something for $9 million and then find a buyer for $10 million. That's how you make $1 million. Really? Like, really? Come on. So this is how wholesaling works. It's definitely find somebody that will sell you something that they don't know what the value is and then sell it for more. That's actually all this is. Now, we've done stuff like this before. It's called double escrow, let's say. Put a piece of land in escrow, and then you flip it out to somebody else, and you actually technically were never the owner. You just had it under contract and sold to somebody else. This is one way to make margin, but I will tell you, it's no way to actually develop a strategy for life. These do come along every once in a while, but this is not real estate investing. I'm just letting you know. This isn't. This is finding somebody that doesn't know what the value is on whatever it is they own, and then finding somebody else to pay more for it. That's all this is. It's really not rocket science here. But the example of finding something for $9 million and selling it to somebody for $10 million is hysterical, because I don't know if I've ever found that. Yeah, so most of these videos have the exact same assumptions. One is that there's some idiot that's going to sell you something for way below market, and you're miraculously going to be able to sell it to somebody for at or more. That's the first thing. Second, home prices are going to go up. Or third, rents are going to go up. So this entire strategy, actually, and there's a fourth, the interest rates are going to go down. You got to be careful with those four strategies. I'm not saying that you should be thinking about those strategies, but those should not be your strategies. Your strategies should be buy in markets that people want to be in. Make sure that it cash flows based on everything that's going on today. And if you're lucky enough to have rent growth, and if you're lucky enough to have rates go down, and if you're lucky enough for prices to go up, then take advantage of that. But to base your strategy on that, buy low, sell high, goofy strategy, that's really just gambling. The reason you guys are seeing all these strategies right now is because all these TikTokers, this is all they've ever seen in their entire lifetime. If you notice, they're all super young, well, generally young. And so all they've ever seen is rents go up, prices go up, and interest rates go down, and they've made a lot of money, and they're cocky. But that's all about ready to change in this next few years. So if you guys really want to learn how to invest in real estate, you should be listening to people that actually have done it. Take a look at this video. Guys, this is a true story about how I bailed out Bank of America on one property where they were losing almost $1 million a year back in 2008.